Okay, so welcome everyone, and thank you for joining us. Um, Welcome to the Venture Insights with Greg Wolf, CEO of Cukierman Investment House. Greg, thank you for very much for joining us.
Yeah, happy to
Cukierman,
be here.
great. So we're going to talk about today the M&A and fundraising environment for Israeli startups, and also the opportunities ahead. Just a quick introduction of myself. My name is Eran Savir, and I'm the founder and managing partner of Savion Ventures. We're a seed stage fund investing in AI, digital, and commerce. Savion is my third fund. Before that, I was a founder myself. I founded three startups, two of which were acquired, and we're doing these events like once every few weeks. Um, Mostly the idea is to educate the community, both founders and investors, with different topics around the ecosystem. Um, just a quick disclaimer before we start. The content presented today is not directed to any investors or potential investors and does not constitute an offer to sell or a solicitation of an offer to buy any securities. Just before we start, please feel free to introduce yourself in the chat box at the bottom of the screen. And also, if you have any questions during the webinar, feel free to write your questions there. Towards the end of the webinar, we'll pick a few questions from the chat. That's it. Let's get started. Greg, thanks again for joining us. Can you please briefly introduce yourself?
Sure. So I'm Greg Wolf. I'm the CEO of Cukierman Investment House. I'm originally from California, originally an aerospace engineer, worked in the aerospace industry for 4 years. Then after my MBA, went to work on Wall Street as an investment banker. I decided at the time that I'd rather do things like work on the merger of Boeing and McDonnell Douglas than design parts for Boeing or McDonnell Douglas. So that was a big motivator for me to get into the industry. And after 10 years in New York, at a couple of very large banks, Morgan Stanley and Goldman Sachs, as a tech investment banker. And for a period at Goldman Sachs, I did media work as well. In about 16 years ago, moved to Israel and started an advisory boutique that was actually a competitor to where I am now, Cukierman & Company, where we did mostly sell-side M&A of Israeli and European tech companies. And I joined Cukierman about a year and a half ago. Since joining, we've really been transforming this firm. Cukierman, of course, is the oldest at 30 years old and 38 people, the oldest and largest Israeli corporate finance house. And we've been pretty dramatically expanding our activities from our current, our previous business was really focused on fundraising and M&A for Israeli tech and life sciences companies. And over the last year, not only have we opened offices in Germany, Korea, and Taiwan, but also hired a number of industry experts in IT services, telecom equipment, mobility, software, et cetera, so that effectively what we're building is, I would call it the first international investment bank that's headquartered in Tel Aviv. And I'm half jokingly calling it Rothschild 3.0.
So great, thank you for that. Maybe to get kind of switch gears here, can you give us like a high level view of the Israeli M&A landscape today?
Sure, sure. I mean, I think we can talk about both. I think it's important to talk about both the M&A landscape and the funding landscape, if that's okay. So
For
I
sure.
have some slides and some statistics that I have on that. So let me just see if I can share my screen. Okay. All right. Can you guys see this?
Yeah, I can see the screen.
Great. So, one of the things I always like to talk about is fear and greed in the investment market. People always say that investors and Iran, I'm sure you've seen this, are constantly oscillating between fear and greed. I think the element that we need to add is FOMO, or fear of missing out. If I feel like a normal year or normal situations for most investors, they're firmly in the green arc of greed on the airspeed indicator. Obviously, when things get too slow and the fear takes over too much, then the plane, can't fly anymore and they stop investing. I think what happened in 2022 and 2021, really, in terms of a lot of companies raised a lot of money at a lot of very high valuations. There was a little bit of FOMO going on in the investor community. So I'd say we went pretty quickly from the yellow arc in 2021 to, at least in the Israeli market, the black, sub 50 here, where there wasn't a lot of flying. But I'd say that, and the statistics will show that we've gotten back into the green arc, as we pilots say. And this can be shown in a couple of ways. I don't know how many of you are familiar with the VIX index. It's a measure of volatility in public markets. And if you look at the, here we have on the left, we have a graph of the VIX of the Tel Aviv Stock Exchange, of the S&P 500, and a consolidated or a VIX of various European stock exchanges. And as you can see, when Silicon Valley Bank, collapsed, all the VIX was up for all of them, but interestingly, the most for Europe. October 7th, when the war started, you could see that by far in this area, that by far investors and investor sentiment was very afraid. The fear index in Israel was very high and the rest of the world very low. And I think the interesting fact is that if you look at where we are today, the first quarter of 2025, that the VIX on the Tel Aviv Stock Exchange is lower than it is both in Europe and in the United States. And with interesting spikes in the S&P 500, both around the time of the election and also around the time of the inauguration. So I think that's sort of a fascinating insight just in terms of investor sentiment in the public markets. It seems that people are a bit more scared about what's going to happen in the US and Europe than what's going to happen here in Israel. And I think that's also shown in the exchange rate of the shekel dollar, where, right when the war started, you could see that it spiked up pretty high for 4.05 to the dollar, and here we are at back at 3.65. So I think it's all a sign of confidence in the market. I think if you think about the funding market as well, you can see, and I think down here on the bottom right is the most important part, where we talk about Q4 2022 versus Q4 2023, and the drop of 32%. But as you can see, Q4 2024, we're already back above the levels of Q4 2022. So the good news is, from a funding perspective, things seem to have improved, and obviously, the more startups that get funding, the more M&A opportunities there are in the future, and so that's a bullish sign for the M&A market as a whole. I think the other interesting factor here is talking about, on the bottom right, just what sectors have been the most interesting ones, and the change from 2023 to 2024. Obviously, defense tech up 140%. There's been a lot of interest in that. But obviously, the software and industrial tech and that sort of thing still very strong and still continuing to grow. Whereas, sectors that were very fashionable a few years ago, like food and ag tech, really aren't kind of growing in this market. But I think the key takeaway here is everybody has become very focused on defense tech because of the war. I think the other interesting fact to note is, and this is obviously the largest deals by year, but if you look at this, on average, You know, the deals across 2024 are even stronger than 2023. And, you know, with the first 9 months of 2023 being sort of a relatively hot market. So I think, again, that's a more positive sign that, you know, on the large investor side for large, growing, stable companies, there's still plenty of willingness of mostly foreign investors to invest. You know, on the early stage side, I think there's definitely a lot of opportunity there these days. And so, but again, overall, less of a calamity than people might have imagined in terms of, you know, funding for the large deals. If you look at exits, you know, again, the 2024 on the top is almost double the dollar value of deals is almost double that of 2023. So again, but not quite up back to the levels of 2022 or the absurd levels of 2021. But I would say that, you know, the good news is that we're really even, you know, with the first 9 months of 2023 being an okay year, not an amazing year, the fact that we are able to have this sort of almost doubling from 2023 to 2024 of deal value is a good sign. You know, as you can see, you know, the average number of years till exit tends to fluctuate, but that's one thing that I think a lot of people have been, as a result of the activities of 2023, 24 and the war, you know, there are clearly some companies that have postponed their exits, and that's seen here in the average number of years. If you look at the you know, stats of 2023 versus 2024, obviously, just, you know, the smallest of the top 10 deals in 2024 is already, you know, bigger than the bottom 6 deals in 2023. So clearly a big comeback, and obviously a lot of acquisitions here from pretty well-known companies. And I think that, you know, the lesson here, and I was saying this all last year as well, is that, you know, companies like SAP and Salesforce and private equity firms like Permira, you know, they've already had so many successful deals of companies that they've acquired in Israel. And so, you know, even with the war, it's hard to tell them, hey guys, you know, even though you've had these successful acquisitions in Israel in the past, you shouldn't do it now. So clearly, you know, they were not paying attention to any, or, you know, not focused on any potential downside of the war, and were very opportunistic in terms of being able to make these big acquisitions during this time. So again, relatively encouraging. Now, obviously, this is only a list of the top 10 deals, and you know, there are a lot of smaller deals that happen historically in the market that have slowed down a bit over the past few years, because, you know, when you're a company like Salesforce and you're agreeing to spend 1.9 billion on a strategic acquisition, it's a bit of a different calculus than you're saying, hey, you know, I'm going to buy this business line for 40 million or 50 million, and the average, you know, tech deal size has been in the double digits for forever in this country. So I would say that while the top deals are a good sign, I would say, and we don't really have statistics here on the smaller deals because not all of them get as reported as the big deals, but I would say that my gut feeling is that the smaller to medium-sized deals have fallen off a bit. Also because for us as a firm, we tend to focus on small and medium-sized deals, and we've seen a bit of a slowdown ourselves. But you know, if you look at the growth, the global year-over-year change in M&A, with the blue line being Israel and the gray line being the global market. If you look at, you know, between 2023 to 2024, you can see already an uptick in the growth rate in Israel versus the growth rate globally, right? I mean, Israel, I think we were up almost 50% from 2023 to 2024, and globally M&A is only up about 10%. So I'd say we've snapped back. If you just look at this graph, you can see that the Israeli market is just more extreme, is more volatile in terms of percent growth or contraction as compared to the rest of the market. And that's partially because there are a lot of large deals that will skew the market, right? I mean, the year that Mobileye got bought for 15 billion, you can see right here. I mean, just the whole market spiked so much because of that one deal really affected everything. So I would say those are kind of the main statistics that I can give right now on the kind of what's happening overall in the market.
So it seems like the market is like picking up, right? Or starting to bounce back. What are the key drivers? By the way, it's not trivial to see that in a year like 2024, where Israel is still kind of at war, the market is actually bouncing back. So what
Yeah.
are the key drivers you think?
Well, one of the things that I always say about M&A is that the most important thing to the success or failure of any M&A process is what's on the strategic roadmap of the potential buyers, right? I mean, obviously it's important to have a good investment banker that you're working with in order to help manage the process. But the reality is that when any of these big companies make an acquisition like Salesforce or like SAP, they don't do it without making a strategic plan of what they're looking to buy, right? There's no such thing as an investment banker calling up Salesforce or SAP and saying, hey, you should buy this company. It's a real opportunity because it's cheap, or it's a real opportunity for whatever reason. Like, none of these companies are opportunistic buyers. They're strategic buyers. And that's why we call them that, strategic buyers. And so, so I think this is also why you can see that even in difficult times, the bigger companies are willing to pull the trigger, is simply because their strategy has led them to believe that, okay, this is an asset that we need to have strategically. And the thing I say about this and the strategic roadmap, if you hire us or anybody to try to sell your company and it's not on the strategic roadmap of any buyer, then there won't be a deal. You could walk me, or one of these companies that got bought for $2 billion, they could have offered, if it wasn't on the strategic roadmap, they could have offered it to the buyers for free, and the buyers would have said no. I mean, I've seen that. I've even seen deals where there's companies where they have a tax loss and a profitable buyer could buy them, fire all the employees the next day, and get just a tax benefit from the government that's like free cash. And they still say no because nobody wants to deal with that headache if it's not a strategic asset. So I think the drivers have been, again, the realization from a lot of these companies that these assets that they're buying are really strategic to them. And given that, and given their, faith in the strength of the Israeli economy and market, that they're still willing to go down those strategic roads during wartime.
So talking about strategy, I mean, you mentioned the word strategy just a few times during the last few sentences, but that's kind of the buyer's side. But let's talk for a second about the seller's side. I mean, founders who need to sell their company or want to sell their company. So I guess, many founders focus on fundraising and are not really building any exit strategy or planning any exit. And, probably there's like this thing that people think that they will get many offers and they can sell rather than I'm sorry, get acquired rather than sell their business. So I mean, why do you think that, or when do you think that founders need to think and plan the M&A strategy?
Yeah, I think it needs to happen early on, and I think it's really a question of making sure that the buyer universe knows who you are, right? And there's several elements to that. I once was told by the then head of M&A of IBM who said to me, if you come to me with a company that you're selling and it's not already on a list of companies I'm thinking about buying, there's almost zero chance that I am going to buy it. If you come to me with a company and it's already on the list, there's maybe a 50% chance. If you come to me and it's on that top part of the list that's circled and highlighted in yellow of strategic importance to IBM, 90% chance that I'm going to buy it. So I think that's important to make sure that, that companies think about who the potential buyers could be and simply, make sure that they know them, right? I mean, I like to use the dating and marriage analogy, right? There's a lot of tech founders and sadly even some VCs in the Israeli market who take the attitude of, well, I'm just going to wait around for a buyer to show up, and that's fine, except for the fact that if there's 10 potential buyers out there who were going to show up and only 2 of them have ever heard of you, then you're really lowering your chances of getting a deal done. I say about it, it's like a woman who wants to get married who puts on her wedding dress and sits in her living room and waits for someone to knock on the door and say, will you marry me? It tends to be more of, if no one knows you're sitting there and you want to get married, then how are they going to know to knock on the door? And so I think
That's clear. So when you look at, like, founders and VCs and the thing that they do, like what are the the common mistakes that founders and VCs do when thinking or approaching an acquisition?
Well, so I would say there's several things that they do. Obviously the first one is this one of waiting for someone to knock on the door and not trying to run a process, right? And not making sure. So I would say step one is make sure you think strategically about who the potential buyers are and that they've heard of you, right? And that can be because you have taken business away from them, they lost to you in the market, or because they met you at a trade show, or because you had a partnership, or whatever it is. So I think that's step one. I think the other mistake that I think people make is that they often companies often try to do these deals themselves, right? I think you'll find that there's certain situations where founders, especially founders that have raised a lot of money, say, "Oh, well, I've raised money. It's a similar process. I can do the same kind of deal and do it myself." And there's a number of reasons that that's not the best idea. Number one, running a competitive process tends to typically maximize the value for the company. You want the process to be competitive, and you want that feeling of competitiveness to drive the buyers to offer more. I mean, if they think that there's no competition, they can offer whatever they want. And similarly, I see a lot of companies that make the mistake of just going exclusive in a negotiation with the first buyer that comes along, rather than taking the time to say, okay, you know what, let's run a process here. Because there are a lot of situations that I've seen where companies might be interested to buy a target, a tech company, but they don't want to engage unless they know that it's actually for sale. Meaning they're not gonna knock on the door and say, will you marry me? But if the matchmaker comes to them and says, hey, here's someone you should consider marrying, then they'll take a look, and mostly for personnel reasons, right? I mean, IBM, again, similarly said to me in that same meeting, we get 5 inbounds a day and we don't have time to look at all of them. And if a company hasn't engaged a banker, we're not going to engage with them because we don't think they're really serious about wanting to do a deal. So I would say that the sort of do-it-yourself mentality, the not getting to know the people, and not trying to run a competitive process, are some of the key things. I think there's also some kind of interesting cultural issues sometimes with Israeli companies, and as someone who's been doing cross-border M&A between Israel and the US for the last 16 years, I can tell you that, there's certain situations where, for example, let's say there's a company where it's worth $100 million, and everybody knows it's worth $100 million, plus or minus, 10 or 20%. And the American buyer comes along and the Israeli founder and says, okay, yeah, we're interested in a deal. How much do you want for your company? And the Israeli founder will say, $300 million, with the expectation that the American buyer will offer $5 million, an equally ridiculous valuation, and that they'll converge on the correct valuation. The problem is that the American buyer hearing this will say, this person is crazy. This business isn't worth $300 million, and life is too short to do business with crazy people. And then they walk away, and then that's the end, And so I think people, especially when doing cross-border deals, need to keep the cultural issues in mind as well.
Right. So by the way, do you think that Israeli founders are, have a more appetite towards like going solo and trying to sell rather than other type of founders?
Yeah, I think so. It's a shame. In America, when a founder gets an offer to buy his company, the first person he calls is an investment banker. And a lot of times in Israel, founders try to do it themselves, or they try to do it just with their lawyers. There's a lot of great lawyers in this country, but they aren't investment bankers, even though they have deal experience, and that's not really, their profession. And so, I hear a lot of stories, like even from lawyer friends, where they'll say to me, I'll meet a lawyer friend for coffee, and I'll say, oh, what are you doing? Oh, I'm working on this $500 million amazing M&A deal. And I'll say, oh, wow, well, are there any bankers involved? And he'll say, no. And then 6 months later, we'll meet again for coffee, and I'll say, hey, what happened to the deal? They, oh, well, it fell apart. And as I say, I would always like to think that, in terms of the price that we're able to get for our clients, that the incremental price difference that we'll be able to get for our clients will always cover the percentage of our fee, right? And we work on a success fee basis, but if our success fee on a deal can be between 5% and 1%, depending on the size of the deal. I've never been in a situation where we haven't been able to get that incremental value that at least covers our fee. But I think the thing that people forget about is, a 3% fee on zero deal, if the deal doesn't happen.
But why do you think it's critical for founders and VCs to work with investment bankers? Is it like just to maximize the valuation, or maybe something else?
No, I think there are several reasons. I would say that obviously maximizing the valuation and creating the feel that there's a competitive process is important. But I think there's a number of other things as well. I used to host a conference in London called Enterprise EMEA, focused on enterprise software. And one year I did a panel discussion where I had the heads of M&A of Microsoft, IBM, Cisco, Software AG, and I think SAP, if I remember correctly. And I said to all of them, so do you prefer to work on deals where there's an investment banker or not? 4 of the 5 of them said yes. And the reason that they said yes, when I pressed them on it, was the primary reasons were it helps with the communications, it helps with the information flow, it makes things more efficient. And so even on the buyer side, they're feeling that it's valuable for them. And obviously, as I said earlier, in the case of IBM, it shows a certain seriousness on the part of the company, that the company's not really messing around and toying with the idea of a deal, that they actually want to do a deal enough that they were willing to hire someone. And by the way, just on a little side note here, I want to say that one of the misconceptions that I see a lot of in the Israeli market is people saying, oh, well, if we hire an investment banker, that makes us look weak because it makes us look like we need to sell. And that's preposterous because none of the buyers think that. That's only paranoid founders think that, and none of the buyers believe that because there's bankers involved in almost all the deals that they do. And by the way, when I worked on Wall Street, when I was at Morgan Stanley, we've had several situations where two CEOs of two companies met with each other without bankers, decided they wanted to merge, and then they called the bankers to help them close the deal
Yeah.
because they realized that there's so much work involved in getting it closed. So I think that those are all important elements to the process.
And so I assume that as a founder who is going to sell their company, you obviously want to kind of maximize the valuation and get as much as you can for that deal, and not necessarily as a founder you know how to build this competitive tension between potential buyers. So I mean, I would assume that going to an investment banker, this is one of the key things that they bring to the table. So how do you do that as an investment banker?
Right. So, I mean, so first of all, as I say, there's several elements of things that we do, not only, to smooth out the process, not only the issue of building the competitive tension, but, making sure that the company materials are ready for prime time, as we would say, ready for presentation to a big potential advisor, that the data room is set up properly, these sorts of things. But also, I would say also that one of the things that happens when bankers are involved is that the buyers tend to behave better. I mentioned earlier that 4 of the 5 heads of M&A said they prefer working with bankers. The one who said no, and I joked with him that I wasn't going to invite him back to my conferences after that, but was the then head of M&A of Microsoft. Now, Microsoft was famous at the time, or maybe infamous, for coming to founders and giving them what we would call exploding offers, where they would say, okay, we're going to give you this offer, whatever we're going to offer to buy your company for $100 million. But if you don't accept the offer in the next 48 hours, we're gone. Now, this is bad behavior, of course, on their part, which they can get away with much more easily if there's no banker in the process, because if one of us is in the process, they know that we know that that's not proper behavior, and we can call them out on it, number one. And number two, that it will be bad for their reputation when we tell people that that's what happened. And so as a result, they generally tend to be on better behavior simply by just by the fact that we're there. And so there's a lot of ways that we can do that. I think it's also important to note that, especially for founders, once a company acquires your startup, typically they want you to work for them in some capacity for a year, maybe 2 years, maybe 3 years, depending on the situation, how critical you are, how much you want to work with them, whatever. But there's always a minimum of a year or so. And you don't, in situations where you're doing a tough negotiation and there's the good cop and the bad cop, you as a founder don't want to be the bad cop if you are going to be going to work with these people starting after the day after the deal closes. And I think a lot of founders forget that. I remember, one of the things that we do a lot of is we talk to heads of M&A of big companies just about their strategy and what they're looking for. So I remember several years ago, I had a conversation with the head of M&A of Palo Alto Networks, the cyber company, and they said they were looking for a certain subsector of security. And I said, oh, what about this company? I happen to know an Israeli company that did exactly what they were looking for. And they said to me, literally, that company is a perfect fit for our strategy, but life is too short to negotiate with people like that. Basically, the founder was being so tough in the negotiations that they just said, we don't want this guy in our organization. He's a jerk. Now, as a banker, it's my job to be the jerk so that you can be the nice guy, you know what I mean? So that they won't say things like that, because they're never going to say, oh, well, life's too short to work with jerk investment bankers because they don't, they want to buy the company. They don't care about us. And so what I say about it is that we can play a lot of different roles in a transaction. Oftentimes we're the bad cop, but we're flexible. Sometimes if we need to be the good cop, we'll be the good cop. Sometimes if we need to be the sacrificial lamb, if the deal goes off the rails and they need someone to blame, even if it's not my fault, I don't care. I'll take the blame if it gets the deal on track, but founders that are running these processes by themselves, once they get off track, that's it. It's over. And I think a lot of the role that we play is, what I call sort of deal glue, or, keep just holding things together so that they don't fall apart.
Great. Just before we continue to my next question is, everyone, just a quick reminder, if you want to ask Greg any questions, I'm going to take a few questions from the chat if there's going to be any questions there. So feel free to write a few, if you have any questions there, and I'm going to take them up from the chat in a few minutes. So Greg, given the surge in the M&A activity in Israel, do you think that now is like a very good time for investors to enter the Israeli market? And also,
Yeah.
what type of companies are maybe the most attractive acquisition targets in Israel today?
Right. Well, so, in terms of investors entering the market now, I think obviously, the M&A and investment landscape has shown us that the Israeli market is extremely resilient. And, from an investing perspective, there are a lot of opportunities. And I think that, the sort of mental mindset shift coming around the war has also created a number of new startups, right? And so I think now, there's kind of never been a better time to invest in the Israeli market. And I also would say that, one of the good things about probably the only good thing about the war is that people have become much more realistic about valuation, right? In 2022 and already beginning in 2023, globally, valuations were coming down quite a bit. But I always feel like there's about a 6-month lag in the sentiment of Israeli founders versus the sentiment of US founders, for example, where the American founders have started to accept the fact that valuations are coming way down, but the Israeli founders still think they can get a crazy multiple for their company. So to a certain extent, I would say that the one good thing that came out of the war is that people were just being realistic about their valuation expectations in Israel. And I think that's important for founders, to be optimistic, and we're optimistic. And obviously we as bankers, we work on a success fee basis. So the bigger the deal, the higher the valuation, the more money we get. So we're with you there. But I think it's important for founders to be realistic about what global valuations are.
I
And
guess this is also another role of the banker, with his relationship with the founder, right? Like some sort of a reality check. What can he potentially get?
I say that M&A is 20% mathematics and 80% psychology. And by the 80% psychology, it's not maybe 40% psychology of the buyer and 40% psychology of the seller, right? The psychology of the buyer creating the competitive tension, et cetera. But the psychology of the seller as well. Definitely much of what we do is managing the expectations of both the buyers and the sellers, and the boards, right? I mean, we spend a lot of time with founders and their boards as well. Where we're working on a transaction where they raised a lot of money in 2022 at a really high valuation, and now they're selling the company probably for less than the value that they raised in 2022. the VCs who were the investors just decided they wanted to sell, and they have a liquidation preference. But in this particular case, there was an issue with the founders where the founders needed help negotiating with the board to get them a bigger part of the deal because they were going to mostly get wiped out because of the liquidation preferences. So much of what we do is also around that, managing the different parties to the deal, the buyer, the board of the seller, the founders of the seller, and in some cases, the investors in the buyer, right? I mean, these days there are a lot of very large private tech companies that are owned by Thoma Bravo or Vista or General Atlantic or Insight or big funds like that, where they're multi-billion-dollar private companies. They're owned by private equity, but they're still making acquisitions. So that adds an extra layer of, not only are you negotiating your sale to the company, but then they've got to go to their investors to get approval. And that's just another layer of people you have to negotiate with, and a level of complexity.
By the way, what trends are you seeing in terms of like buyer profiles? Are you seeing like more of strategic buyers or financial buyers or maybe a mix?
I'd say I think the Israeli M&A market has really been much more strategic over the years, right? If you think about, the number of there haven't been a whole lot of tech private equity deals in Israel as compared to tech VC deals in Israel. And there's a number of reasons for that, mostly because I think a lot of the Israeli tech companies tend to get sold before they're large and profitable enough to be targets for private equity. There have been a few. I think Priority Software was one a few years ago, and one or two others. Of course, there have been a few.
Iron Source got a large investment.
Yes, right. Yeah, but again, but they're very few and far between. There's maybe two or three deals like that a year at maximum, as compared to 100 plus or several hundred of the smaller M&A deals. And again, what Israel is good at is creating new technologies and creating new startups that get sold to international buyers. Israel as a country is less good at creating large private equity type tech companies. And let's not forget that one of the types of tech companies that tend to get sold to private equity tend to be large and either slow growing or not so profitable. And so I think Israel is always very focused on growth, and so that's just one reason that they're more of the smaller, earlier stage deals than the later big deals.
So zooming into like the Israeli ecosystem, few questions about that. So,
Yeah.
For investors and, potential LPs who are looking to take advantage of the current situation in the Israeli market and the, potential, to capitalize on the M&A trends in Israel, what would you recommend? Like how to approach that?
From an investor perspective, or from
Yeah, yeah,
from an LP type investor perspective,
yeah,
or
both.
yeah.
Those who like understand the opportunity in the Israeli market. Okay, how do I capitalize on that as an
Right.
investor?
Well, I would say that, listen, obviously the VC community in Israel is kind of the main driver of all of this, and most of the successful investments that we talk about, or the companies that we work with, are VC backed, right? It's hard for a lot of individual investors, I think, to without either investing through a fund, or to get, number one, the individual deal flow, plus the sort of scale efficiencies of working with VCs. And I think also that there's and in Iran, you know this as well as anybody, but that a lot of VC funds, they'll have 20% of the top 20% or the top 10% of the portfolio makes all the return or most of the return. And so for individuals to be investing in individual companies is nice if they have a very strong conviction about that. But often, can the process of going through a fund where you have a diverse group of companies that you're investing in ends up being a more successful strategy. Now, not all investors have access to funds, but I think the ones that can, should try to go that route. For the ones that don't have access, obviously they have to invest in other ways, and there are other ways to do it. But for people who have the possibility, I think it's generally just better deal flow, better best practices, more diversity, and more hedging of the risks. So I think
Great.
that's probably the way that I would think about it.
Awesome. Thank you for that. I'm gonna go to a few questions that we got through the chat. So, are there any recent acquisitions in the aerospace and defense sectors that you were involved in, or
So we're actually working on a deal right now, but I can't say yet because it's not closed. But actually, and this is quite interesting, is that it's an Israeli defense firm that's looking to make acquisitions outside of Israel. And so it's a buy side advisory transaction for us. But there's I know from our experience that there's several especially in the defense market, there's a lot of noise right now, and a lot of activity, and I think we'll see if we were to have this conversation again this time next year, more than a few closed deals in the sector, some by us and some by our competitors.
by the way, it's interesting to see that it's kind of like a market that Israeli companies buy Israeli companies, right? It's relatively like a new trend, right? Do you think
Yeah,
that?
it's surprisingly, it's one of those things that I'm seeing a lot more of Israeli companies of all sectors trying to make acquisitions outside of Israel to grow. And I think it's really a sign not only of the maturity of the market and the maturity of the founders themselves to understand that, we've got to grow through M&A, but also of the maturity of the investment ecosystem, right? I mean, when I moved to Israel 16 years ago, what they used to say then was, there's no growth capital in Israel. Israeli tech companies can't get big because there's no growth capital. But we go back to the slide I showed at the beginning where, there were growth equity rounds of multiple hundreds of millions of dollars just for one round. And obviously that exists. And a lot of that is funding M&A, right? Not only of Israeli companies buying other Israeli companies, and we've seen that too. There are deals that are in the market where big Israeli tech company funded with a huge growth round from a foreign investor uses that money to buy a company, another Israeli company. And we've also seen instances of, those as big Israeli companies using that money to buy companies around the world, in Europe, in the US, wherever it takes. And I think we're going to see more and more of that as, I mean, let's face it, there's something like 90 unicorns in Israel, which is more than all of Europe combined. And one of the best ways for them to grow is to acquire. And if you think about, back in the when I was doing lead managing IPOs at Morgan Stanley and Goldman Sachs, those companies were going public at $500 million valuations, and then already thinking about doing acquisitions then as $500 million valuation public companies. So if you're a $2 billion cybersecurity company and you just put $200 million of growth equity in your pocket, of course you're going to use that for acquisitions. Obviously you don't have the public shares, but you have, there's plenty of people who will accept private shares these days in a company like that. And so
Yeah.
we see a lot of those deals, and we'll only see more.
Going back to the questions in the chat, if we agree that the downturn in Israel's high-tech sector was mainly driven by the war after October 7th. Which factors allowed Israel to get back as its previous momentum, as in 2022, despite the ongoing conflict
Well, yeah,
around?
so I think we touched on that a little bit, which is that, the idea that what's if it's on the strategic roadmap, they're going to do it no matter what, and I even say that if some big company has a strategic roadmap and there's a target that does exactly what they need for their strategic roadmap, they will overpay. I mean, I've seen deals where I kind of scratch my head at the valuation, and then I realize, yeah, okay, well, they must have had some strategic planning session 6 months before that deal where they said, boy, this is the direction we have to go in, and they found exactly that. And Microsoft buying Skype and paying so much money for it. Now, in retrospect, yeah, now a bunch of us use Microsoft Teams, and all the Skype technology is built into Teams, and it worked out for them because it was on the strategic roadmap. But there's certain times where you kind of, whenever you look at a valuation on a deal and scratch your head, it's usually because that was the exact thing that was on their strategic roadmap, and they didn't want to let it get away. And so I think that's really what's driving things here.
Great. Next question. Can you, I guess, walk us or talk us a bit more about the cultural issues that is important to understand when working in Israel?
Yeah, so we talked about a few of these already, right?
Yeah.
I think number one, this issue of the don't be crazy in the negotiations, right? Or even things that people would in Israel might take as a joke, can horrify foreigners. Like I was working on a deal a few years ago with an Israeli company where they were talking to a German investor, and me and the CEO and the chairman flew to Germany to meet the investor. And at a certain point during a somewhat contentious negotiation, the Israeli chairman says, okay, none of us are going to leave this room until we come up with a deal. And the Germans thought that was some sort of a threat, and they were horrified. I mean, I think he meant it good naturedly, like, oh, let's double roll up our sleeves and get a deal done. But by putting it that way, immediately let all of the air out of the balloon. And so I feel like, it's very important to understand that not all cultures are as aggressive as Israeli negotiating culture, and that sometimes it can scare people off, and that there needs to be, somewhat of a buffer there. I think also, there's a certain element of, I say about it that sort of half jokingly that in the rest of, in America, the way they do things is ready, aim, fire. And in Israel, it's often fire, ready, aim. And so, I think having your materials, or as we say, having all of your ducks in a row, is very important. When the buyer comes in and looks and sees your data room and it's a disaster and it's really disorganized, that's bad, especially if they're German or if they're American, that they expect it to be super organized and super put together and super thought through. And so, the sort of yeh beseder culture doesn't always work there, and there has to be a certain level of a minimum level of organization, and I think the last thing, not the last, but one of the other issues is over the years, and I think this is changing. I've seen this change in the right direction over the last 16 years that I've been in Israel, but I think Americans often negotiate with the concept of win-win, and I think Israelis often see negotiating as a zero-sum game, and I think that you have to know who you're negotiating with and what their style is, and if they're a win-win and you're trying to do zero-sum game, it's not going to work because there's no way for you both to win if it's a zero-sum game.
Great. Last question from the audience, and then I have my last question, and then we're almost out of time. So quick answer to this short question. Do you see the stock market coming back?
The SPAC market is already coming back. The firms that underwrite SPACs are continuing to underwrite them. Although, I say the same thing about companies that try to either do crazy deals like a reverse merger into a shell or go public, an Israeli company that wants to go public on some crazy foreign exchange or even go public very early in their lives on the Tel Aviv Stock Exchange. Just because you could do a deal doesn't mean you should. And so, I think SPAC was a dirty word for many years, because typically the companies that promoted them were the only ones that made money. And there was this crazy year and a half period where everybody was doing it. But the results of that were such that, even Goldman Sachs was in the SPAC business for a year and a half, but today they're not, and it's gone back to the sort of shadier firms leading the charge on the SPACs, and that would have me a bit worried. So I'd say that yes, it's probably going to come back, but that doesn't mean you should go running towards it.
Awesome. So this is my last and final question, and then we're going to wrap up. So what's the craziest or most unexpected thing you've seen happen in an M&A deal, and what's one key lesson that every founder or investor should take from it?
Yeah, so this is a story, a sad story, but unfortunately not atypical for the Israeli market. And that is that several years ago there was a cyber company that got an offer from a large American buyer to buy the company for about $300 million. And I was friendly with the lawyer of the company who was telling me the story that I advised the client. I said to the client, why don't you hire an investment banker to help you run the process? And the founder said, listen, I barely have any revenue in this company, and these guys are offering me $300 million for the company. I never thought I'd get this much. Why would I bother to pay a fee to an investment banker? A fee on a deal that size would have been 1% or some 1.5%, something like that. And so in order to save 1.5%, the founder decided to do it himself, DIY, $300 million M&A deal. And they closed the deal for $300 million. And a couple months later, word got out that the board of the buyer had authorized them to pay up to $500 million. And so the founder saved $3 million, but lost 200. I think a lot of times in the attempt to, that's the definition of penny wise, pound foolish, right? You saved a couple of pennies on the fee, but you lost $200 million. That's pretty crazy, and that's something that really needs to be avoided. It's bad. It's a bad outcome for everybody except the buyer.
For sure. Yeah. Work with professionals, I guess,
Yes.
right? We need to remember that.
Yes.
Greg, thank you very much for this session. It was amazing, epic, very, very educational. Thank you very much.
Thank you for having me.
Thank you. And thank you, everyone. Good night or good morning, wherever you are. And see you next time. Bye-bye.
Thank you.